All right, let's jump right in. Ever wonder what happens when a huge event hits a company after its financial year is over, but before the reports are actually out? That's what we're digging into today. Think of it like being a financial time detective.
So, let's put you in the hot seat. It's January 5th. Your main warehouse just burned to the ground. Total disaster. The question is, does this change your financial results for the year that just ended on December 31st? I mean, the year's done, right? This is exactly the kind of tricky spot that the accounting standard IAS 10 is built to handle. Okay, so to get to the bottom of this, we first have to map out the scene of the crime, so to speak. And it all happens in this very specific window of time.
So here's the official lingo from IAS 10. We're talking about any event, good or bad, mind you, that pops up between the last day of the financial year and the day the big bosses officially sign off on the financial statements. This isn't just a quiet period, it's a super critical window where new information can totally change the picture.
And this timeline here is key. The most important part is that end date, March 18th, the date financials authorized for issue. Now that doesn't mean it's when you, the shareholder, get the report. No. It's the specific day the board of directors gives their final stamp of approval. Once that happens, that's it. The book for last year is officially sealed.
All right, we've got our time frame locked down. Now, every good detective needs a key, right? A single question that cracks the whole case wide open.
And this is it. This is the absolute heart of IAS 10. Does this event provide evidence of a condition that existed at the end of the reporting period? Just let that sink in. Every single thing that happens in that in-between window gets run through this filter. Was this problem already there on December 31st, just hidden, or is this something totally new? The answer to that question sends you down one of two completely different roads.
And here are those two roads laid out for us. On one side, you've got adjusting events. These are clues about the past. If the answer to our big question is yes, then you have to go back and actually change the numbers in the financial statements. But on the other side, you have non-adjusting events. This is news about the future. If the condition wasn't there at year-end, you absolutely do not change the numbers. You might have to write a note about it, which we'll get to.
So let's walk down that first path, the one where we literally have to rewrite a piece of financial history.
Yeah, think of it like this. The story was already written on December 31st. You just discovered a missing page. These events aren't introducing a brand new character or a crazy plot twist. They're just confirming a situation that was already there. They're the last piece of last year's puzzle.
Okay, let's look at some real-world examples. Say a huge customer goes bankrupt in February. Well, they were probably in deep trouble back in December, right? So the condition existed. You have to adjust your books. Or a court case that's been dragging on for ages finally settles. That settlement just tells you the true cost of a liability you already had. See the pattern here? In every case, the underlying issue, the shaky customer, the lawsuit, was already a thing at year-end. All right, now for the other path. What happens when the event is genuinely 100% new, something that started after the clock struck midnight on New Year's Eve? These events are a big deal, for sure, but they don't change the past. They're not the epilogue to last year's report. They're the explosive opening chapter of next year's financial story. They belong to the future, not the period we're closing the books on.
And here are your classic examples. A fire destroys your factory in January. A massive stock market crash happens in February and tanks your investments. You announce a major restructuring plan. All of these things happened after December 31st. The condition didn't exist before that. So, back to our big mystery from the start. The warehouse fire on January 5th. Let's ask the question. Was the warehouse on fire on December 31st? Obviously not. So the condition arose after the reporting period. It's a textbook non-adjusting event. You do not go back and change last year's numbers. Case closed, right? Well, not quite. Not so fast. Because even when you don't change the numbers, you're not off the hook. There's some really important fine print we need to talk about. It's all about being transparent and knowing when a problem is so big it breaks all the normal rules. So, for any of these non-adjusting events, you have to ask, is it material? Which is just a fancy way of saying, is this a big enough deal that an investor would want to know about it? If the answer is yes, you can't just ignore it. You have to explain what happened in the notes to the financial statements, and if you can, you've got to give an estimate of the financial damage. It's all about transparency.
But then, there's the one exception that trumps everything, the nuclear option. This is for when an event is so unbelievably bad that it threatens the very existence of the company. You see, all of accounting is built on this one simple idea, the going concern assumption. It's the belief that the business will keep on running for the foreseeable future.
But if an event after year-end, let's say that fire destroyed your only factory and you have no way to rebuild, if that makes it clear the company is going under, then all the normal rules go out the window. You can't use regular accounting anymore because there's no foreseeable future to account for.
So you might be thinking, wow, these are some complicated rules. Why do we even have them? Well, it's about something way bigger than just accounting. It's about trust.
What IAS 10 does so brilliantly is it performs this incredible balancing act. On one hand, it protects the integrity of that year-end snapshot. It makes sure the numbers for December 31st are a true and fair view of that specific moment. But on the other hand, it makes sure that investors aren't kept in the dark about huge, game-changing events that happen just a few weeks later.
At the end of the day, that's what this is all about, protecting the integrity of the timeline. Our financial detective is drawing a clear, sharp line in the sand. It separates what we knew then from what we learned later. And that separation is the bedrock of any financial report you can actually trust.
So yeah, we always say that financial statements are a snapshot in time. But what a rule like IAS 10 really proves is that the real story, the real skill, isn't just taking the picture. It's deciding which moments actually belong in the frame.